What is up, YouTube? This is the Working Investor. This is a well overdue video about my return in August. It's been embarrassing to talk about this negative return. I did kind of make several videos and talk about how bad it's going to be, but in this video, I've finally took the stomach to calculate everything. And actually, I was pretty surprised that it wasn't as bad as I thought it would be. And I want to credit basically a strategy that's called core number compounding. That's a term. It's a term by the Oracle, aka Yield Max TV, and basically it talks about ripping off the top. We'll talk a little bit more about it in a second. So let's look into the August return. So in August, basically, we're going to go to the. I'm sorry about the spreadsheet, but I really have to try to keep track and see what's going on. So in August, I started transitioning into into the more into the high yield dividend ETF space and out of options. And the beginning of the month started off with these really bad trades on August 5th when the market took a tumble. The big one was Nvidia. I had a put that was upside down, and I took a realized loss of 29.50. Ouch! And then I had a put that was in the T triple Qs, a $79 put that went upside down, and I lost 16.50 getting out of that trade. So I started off the month with, what is it, like almost 40, 45, $4,600 in the red. And I spent the rest of the month trying to see how close I can get to zero. It was the goal to get to as close as I can to zero. So this is representative of all the trades that I made in the option space and also the high yield dividend distributions. And I started from a negative 45, 4,600, ended up making, coming out with negative 2,035. But this does not include core number compounding, which I promised I'll get into in a minute. So you could see that from negative, so I'm already 26-ish, 25, 2,600 of movement towards, in the positive. And then I started, because I did all these trades in core number compounding, I had to start keeping track of it. So core number compounding is basically you focus on the core number. This is a term by the Yield Max. Well, he has a new channel now, so it's the Oracle. And basically, we're very good in looking at buying the dips, but we're really, really bad in, actualizing profits. And we see our account go up and down all the time, but we don't do anything when it goes up. And when on an up day, a lot of us don't take advantage of locking in a return. So core number compounding makes it really simple. Let's say you focus on a core number, hence core number compounding. Let's say your core number is 5,000. When you see that you are at 5,200 in whatever underlying we're talking about, one would theoretically rip off the top, clip off to sell $200 worth of, of the underlying, and keep the $200 on the side. Either put that build it up into a different thing that you want to build up, keep it as a cash, as a hedge, take it out and spend it. But don't just let that money just sit there. Of course, it would cause in a taxable account, most likely this would cause a taxable event, right? Short-term versus long-term capital gains. You got to speak to an accountant. I'm not an accountant, not a financial advisor. Don't do what I do. But I like to do it this way. And then you could, or at the very least, if the market goes down one day, you have a $200 safety net that you can go ahead and buy in at cheaper prices and have more shares. So when we're talking about high yield dividend ETFs, you can always decide, hey, like I could maybe sell 5 shares that's overweight. And then if your underlying drops, let's say on next dividend date, now you could buy for the same value without putting more money out of pocket, maybe 7 shares. So you can so that's what we do on red days. So you could see here all these transactions that I ripped off the top. That's what it means, selling into pump, selling on up days whenever you're above your core number. I try to, maybe 1 to 2% above your base, your core. So total that you don't see, these phantom gains that I got, we call it rips. I ripped off the top was over $1,300. So now I started with negative 45, 4,600, and I brought it down to like around negative 2,000, and then ripped off additional 1,300. So that's also profit that most of it just got reinvested to buy in at a lower cost basis, but it's still money that I was able to rip off the top. So let's see where the total return. Oh yeah, so it was about 1,300. It was about no 700. Let's go right here. Yeah, a negative $704.37. So that comes out that, you know, that's not bad from negative 4,600. So my total return was negative 10.23%, and this is a bad month. But this is really, really helpful, this core number compounding. I started doing it recently, even on this month. Right now, you could see we had a green day the other day, and you could see I ripped off on AMZ, on Phoebe, Ulti, XDTE, QDTE, SpyT. I ripped off already for this month $1,238.55, and I used a lot of that to build up my FEPI. And something to note as well, SpyT basically, is a defiance ETF, and there's some people that go for the really, really high yields, but of course sometimes the net asset value does go down, but people have to look at total return. So if you have something that pays, let's say, for example, Ulti, which right now I got a distribution of Ulti of $884.25 on a $10,000 core number, that's 107.58% annualized return on an annualized basis. That's an 8.84% return this month, which is 107% return. So if something returns, let's say 100% return, and it drops 30% theoretically in value over the year, then 100% return minus 30, so your total return is 70%. So those are pretty cool. You have to look at total returns. But then there are some ETFs like middle of the road, let's say 20% return. Let's say, for example, right here, this was SpyT as we were talking about, right? SpyT. So my core number for SpyT is 5 grand. If I'm above 5 grand, I rip off the top. Last month, I got $83.66, which comes out to be a 20.36% annualized return on an annualized basis, or 1.67% for the month. So, and the net asset value historically has kept roughly stable. And the good thing is there were some updates, and you could see over here, even though I got $83 and change in dividends, and I probably expect around the same, maybe a little less because I sold a few shares, let's say around $80, I've made more than the dividend. I made almost triple I made $98 from ripping off the top on the 17th. I made another $79.76 ripping off the top on the 19th. So I pretty much, made my dividends several ways over. And this is because, yes, people think, oh my God, you're cannibalizing your fund. Why are you cannibalizing your fund? No, my core number is $5,000. That's how much I want to invest into this fund. More than that, I'm overweight. It also helps you rebalance. It keeps your portfolio, it keeps you objective. You know what I mean? If you're, for me, it's very simple. If I see that I'm under 5,000 on a core number, then 100% of the dividends I will reinvest, because I need to build it back up to the money that I put in. I need to get my money back. I need to be able to be whole again. If I'm overweight and it's above my core number, then I can keep 100% of the dividends, either keep it, spend it, put away for taxes, or use it to build another position, or keep it on the side for a rainy day. When there's a red day, I can go ahead and buy more shares when it's below that number, without putting new money in, just with the money that the fund itself gave. But on a green day, I can go ahead and rip off the top. So because some of these funds, these middle of the road funds, they tend to only have only a 20% annualized return. If you think about it, around $80 is 20% annualized return, but I got 3 times 80, right? So I got maybe 60% annualized return. You don't see that in the background. So that's one of the cool benefits people don't talk about with these middle of the road funds. Anyways, my rant is over. Again, this is just my opinion. I'm just a retail investor. I'm not giving you guys any financial advice. Look at all my disclaimers. Have a wonderful weekend. This is the Working Investor, over and out.